reason the markets look through the copper issues, I think, is if you actually run the numbers, because of the 17 billion of imports that the US has of copper and the significant amount that it self-sources, actually it's about 0.2% impact on the effective tariff rate. And this is a market where we already know that these are coming in somewhere in the middle teens. So the markets have, to my mind, moved on from this. They're looking at the dominance of the tech sector. They're looking at the AI trade. In fact, our quant analytics suggest that the biggest driver of equities this quarter has actually been the AI theme, not the tariff theme. And that's why I think we're making all-time highs.
And this is the reason why so many people have come on this program and said that they like U.S. equities, they don't like U.S. debt. They like U.S. equities, but they're worried about the dollar. There still is exceptionalism. It's just in a smaller pocket, and it has to do with AI. Are you a believer in that?
Well, I think you've got to unpack U.S. exceptionalism. And so there's one level of US exceptionalism which I think is probably acceptable to the administration, and that's the dollar giving up some of its excessive valuation. We've heard chatter about, concern around currency manipulation. It's never really gone away. But with the dollar weakening, because there's just simply less demand for it, that's taking that issue away. But we're seeing very little evidence of this idea that the dollar is ceasing to be king dollar, the reserve currency. I mean, 40% of global trade is invoiced in dollars, even though the US is a counterpart in only 10%. So, and the institutional strength of the US compared with other regions is still paramount. So you'd need to attack both of those bases before you'd start to unwind the dollar. As for stocks, look, if we unpack the S&P 500, the tech giants continue to be global leaders on relatively decent valuations with strong earnings. The rest of the S&P, actually, it's getting up towards quite peaky valuations. So we do look outside. We look for diversification. Hong Kong, emerging markets, the UK, and Europe's beginning to look really interesting, given the fiscal thrust that's coming next year and the fact that what we're also seeing is the ECB be able to respond with much easier monetary policy because of the disinflationary impulse that tariffs create for the rest of the world ex-US.
So how do you play that? Jean Bovin, BlackRock, was on earlier, and he said that he liked European bonds versus U.S. government bonds, not so much European stocks relative to those in the U.S. Do you agree? I mean, do you prefer European bonds to the U.S. ones because of the ECB's proclivities to possibly cut rates, even in the face of that fiscal expenditure?
Well, so we do continue to like European bonds in preference to the US for the reasons that we think that what's happened with tariffs and all the chatter about national security has actually forged a common purpose for Europe that we've really not seen for some time. And so the spending that's happening, if you look at what's happening with Germany's spending, by the middle of the 2030s, it only takes German debt to GDP to around about 80%. The European Union, particularly Germany, have massive fiscal headroom. And we've got the disinflationary impulse. We've got Europe pointing in the same direction generally now. So it means, some of the periphery markets, the Spanish market, the Italian market, etc., look particularly interesting as a place to pick up carry, pick up some decent returns there. But I wouldn't write off European equities right now. Yes, they're a little bit more expensive. But if I told you at the beginning of the year, you know what, we're going to see European earnings expectations for 2025 go from 8% to 1%, what would you think the market would have done? You wouldn't expect it to have been up 10% year to date. The market now is pricing a very shallow forward earnings curve just at a time when we're about to see a significant fiscal and monetary boost. So we're beginning to get quite excited about the European asset market in general, but certainly leading off with the bond market.
But aren't European equities going to be the most exposed when it comes to the tariff risks?
Well, I think what we've already seen is that's been priced through the earnings forwards. So we have got Europe trading at around about 15 times forward multiples, which is significant premium to where it's been over the last 10 to 15 years, albeit that was a period when Europe was resetting its balance sheet with regard to the bank's post-Eurozone crisis. So yes, there's a lot of tariff potential impact, but we also have one of the most powerful negotiators out there, the European Union. And so I do think that some of the saber rattling that we're seeing from the White House should be taken seriously in terms of thinking what it means for Europe. But make no mistake, Europe are incentivized to come to an agreement and move forward. But what it's also doing is it's forcing Europe to look inwards. It's the biggest consumer market on the planet. It's twice the size in individuals of the United States. And we're beginning to see self-help. Fiscal spending, monetary support, and as a result, I think what we can see is a little bit more potential for Europe to play catch-up.
You laughing at the Europeans?
Well, it's self-help. Chicken soup for the European soul. I just picture this. There's nothing quite like having a common enemy. That's all I can say.
They need it. Right now, they've got to eat Chinese deflation. I was looking at PPI out of China overnight. The 33rd month of negative factory prices out of that country.
Overproduction. Yeah, overproduction. And where is it going to go? And that's really a question. And that's part of the reason why the ECB may have the ability and desire to cut rates.
The ECB doesn't look comfortable right now. I have to say that. Listening to the officials in the last week or so, you make it sound quite straightforward. I agree with you. It should be. But that's not what I'm hearing. They're worried about the FX channel and then doing nothing about it.
But look at it in terms of euro-dollar versus trade-weighted euro. Excuse me. Euro-dollar has moved around 12–13%, so that's significant for that currency pair. But, of course, in trade-weighted terms, the euro's moved around 7%. So meaningful, but bear in mind that the bilateral trade with the US, while clearly important to Europe, is not the only barometer that they look at. We're just beginning to see a little bit of nervousness coming out in terms of some of the commentary from Sintra around the level of the euro, but I don't think this is in any way panic stations yet. And, you know, if anything, when we look at it against our long-term fair value, again, going back to euro-dollar, we see fair value somewhere around 125. So pushing up to the upper teens, perhaps the 120 level this year, I don't think is going to scare the horses at the ECB too much.
John, it's good to see you.
Good to see
you. As always,
you too.
thanks for dropping by, and thanks for trying to explain what Charlton Athletic is to Anne-Marie in the commercial break. Good attempt. John Bilton there of JP Morgan Asset Management. What did you say? That's not a real football club?
Well, it sounds a little bit like a Mickey Mouse football club.
OK. Hope Charlton's not listening this morning. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
From a Charlton fan, John, not happy about that. Here's your news, though. Investigations are underway in the deadly Texas flash flood. They're looking into when weather forecasters advised local officials about flooding and what those officials did to spread the message to thousands in the area. The floods killed over 100 people and 161 are still missing. Elsewhere, the Supreme Court gave President Trump approval to cut the size of the federal government. The decision lifted a court order that blocked federal departments and agencies from slashing their workforces. The coalition of federal employees, non-profits and local governments said that the decision, quote, dealt a serious blow to our democracy. And finally, US consumer borrowing increased in May at the slowest pace in 3 months. Federal Reserve data shows credit card and other revolving debt outstanding declined $3.5 billion, the first decrease since November. Non-revolving debt, such as loans for vehicle purchases and school tuition, increased $8.6 billion. That should be the brief. John.
Lizzie, I had no idea. I apologise on behalf of the programme. Up next, the Morning Calls Plus. Sucharika Kadali of Forrester on signs Amazon's Prime Day is set to disappoint. Their conversation's next. Live from New York City this morning. Good morning.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
So here's the runway for the next month or so. July 15th, CPI. 2 days later, retail sales. Go on to July 30th, a Fed decision. 2 days later, August 1 payrolls the same day for the next trade deadline. A lot still to come over the next few weeks. Equity futures at the moment grinding higher into it, up 0.2% on the S&P. On the NASDAQ, up by 0.2% also. That's the price action. Here are your morning calls. First up, Oppenheimer upgrading Microsoft to outperform, seeing the company as one of the long-term AI winners in software. That stock is up by 0.75%. Your second call from Barclays, raising its price target on Netflix to 1,100, writing legacy media earnings could surprise to the upside. And finally, Citi raising its price target on UBS to 127, seeing balanced risk-reward for transport stocks due to a still soft demand backdrop. The stock is positive by 0.6%. Let's stick with a consumer. Amazon seeing a sluggish start to its annual Prime Day sale, with sales falling almost 14% in the event's first few hours compared to last year. Bloomberg's Poonam Gaur joins us now for more. Poonam, welcome to the programme. I think our first question, our only question really, is whether this is an Amazon problem or a consumer issue.
I think it's a little bit of both, but you have to remember that the event is 4 days this year, not 2 days. So consumers have time to come out and spend.
Is brand Jeff Bezos and the recent wedding dent the enthusiasm over brand Amazon, Poonam? Do you see any of that at all?
I think consumers are looking for deals right now, and Amazon's providing the deals. So I think most will just focus on the deals and their budgets to maximize them, which Amazon and other retailers are providing them to do this week.
What's tickled you?
Well, I think that's just funny because I do now think of Amazon. I'm a little bit like, oh, is it a little tacky?
Based on the wedding?
Based on the wedding, yeah.
Okay.
Also, the
That's your
deals.
association with
Also,
them now.
the deals. They're saying these deals for the AirPods are supposed to be the best, but if you Google them, you can get the same exact price on Walmart, and they're not having some special Walmart day. So I don't really know if there's real deals to be had.
Poonam, we saw plenty of pull forward in the first few months of the year. The threat of tariffs hanging over the consumer. There is an open question as to whether we've worked through a lot of that pre-tariff inventory. How much inventory is left?
I think there's very little pre-tariff inventory left. As far as what I'm seeing and what I'm hearing from retailers is that 2Q deliveries have the tariff rate built into them. And as the rates are subject to change over the next 2 quarters, especially holiday, prices could rise even further. So deals still matter, and they still matter a lot. I'd say, we'll know a little more in the next day or two. I did see data this morning from Numerator, which basically said the first 16 hours of Prime Day, the average order size was a little over $58. And if you compare that to last year, the first basically more than 30 hours, the average spend was over $60. So there is a deceleration, but I'd say there's still time for people to come and shop.
Poonam, appreciate your time. As always, Poonam Gaur there of Bloomberg Intelligence. To extend the conversation, Sucharita Kadali of Forrester writing, retailers will be more cautious about discounting too early in the year should there be supply chain issues or heavier hitting tariffs. Joining us now, Sucharita. Sucharita, let's just talk about the tariffs so far and pick up on that last question that we asked Poonam Gaur. The amount of pre-tariff inventory there is still at these retailers for them to work through, or are we getting to the point where they've got to make a bigger decision?
Well, there are so many factors to consider with tariffs and the amount of inventory that you're going to hold, because retailers just don't have an infinite amount of cash on hand that they can invest their working capital in this inventory that they want to front load. So it is a balance between front loading the things that you know are definitely going to sell and are not perishable and will be able to have some shelf life, while also maintaining the reality of how much you're likely to do in sales. If retailers pull forward too much inventory, what they end up doing is that they're risking cash flow, and ultimately the lack of cash flow is what drives retailers to bankruptcy.
Sucharita, if you put this all together, what does it say about the prospect for deals? We were looking through Amazon for deals and not finding as many as we have in the past. That doesn't speak of desperation to clear the shelves of any existing inventory.
My hunch is that marketplace sellers were probably a little bit more cautious with what they were able to offer Amazon in the first place. Amazon works by everything that sellers have shared with us. They work long in advance to get the deals. And what has likely happened is that tariffs earlier this year threw a wrench into things. And as a result of that, we just saw prices likely going up, not substantially, but enough that you wouldn't necessarily see the great deals that you'd see otherwise. So it's not surprising that likely there are more categories that are now offered for sale. We certainly are seeing a greater number of days. And over the last few years, we've seen multiple Prime Days. Amazon now runs this event twice a year. They have it in July and October, in large part to be able to comp the previous year's numbers.
Which really goes to the point of how much can we really gauge or extrapolate out consumer demand from these numbers at a time where I know that in my household every day is Amazon Day, and it's sort of how many things can you possibly buy? I just wonder, is that sort of your read through? Is that both the sellers aren't really offering amazing deals, they're kind of not buying into it quite as much, and the buyers aren't rushing to front load their orders because they can do it at any time? Is that kind of what we're seeing? And it kind of takes the winds out of the sails of people who say this indicates that consumers are falling off a cliff.
Right. I think that what you've just suggested, which is the truth, is that consumers are honestly a little bit jaded by some of these offers that are out there. So there's the combination of the fact that they are not as excited. And by the way, when you have multiple types of offers over multiple days, we've even seen sort of the drop off happening around Black Friday and some of those key dates that historically during the holiday season were big selling dates. But as you add more, as more retailers have more products for sale, it's just not as special anymore. So you have the jaded shopper. And then on top of that, we have all of the economic issues, the consumer confidence issues, and the fact that that we did front load a lot of transactions in Q1 and Q2. Retail continues to be fairly resilient. And a large part of that was the pull forward that we saw earlier this year due to the threat of tariffs.
Sucharita, you mentioned in your note later in the year where there could be supply chain issues. What kind of supply chain issues are you starting to think about potentially that some of these retailers could be hit with?
Well, it's really if there are ultimately some of the tariff discussions do actually come into place. So a lot of what has happened has been the threat of tariffs. There are some regions of the world, some product categories that are facing higher costs, like in China. But for other parts of the world, there's essentially been a moratorium. But that led to a lot of uncertainty and a lot of concerns around, well, let's get ahead of this and let's pull forward whatever we can, both from a consumer standpoint as well as a merchandiser standpoint for wherever that was possible. Now, we are coming up to the 90-day limit, and what we may see is the resumption of some of those threats of tariffs, even in regions in the world where we haven't seen them before. So other parts of the Far East or India or even products coming from Europe. So in that case, in that scenario, you're absolutely going to see either higher prices, which will lead to inflation, or you're going to see just lower inventory availability because the retailer is simply going to be buying to what is absolutely essential and not have any excess inventory in stock.
Sucharita, great to get your thoughts. Sucharita Kadali there at Forrester, the latest on Amazon Prime Day and what retailers are doing. It's a process, and that process is continuing. They had to work through a lot of pre-tariff inventory, and then we can figure out how much they're going to take on margin. Once we figure out how much they're going to take on margin, you can start to do some sums about what it could mean for cost cutting elsewhere, including the labour market. And that might be months and months down the road still from here.
So if you're looking for clarity, maybe hope can be your strategy. But right now, it doesn't seem like that's the case. As we were talking, I got an Amazon Prime email tailored for me.
Finally, what'd you
get? With some specific deals, 25% off socks, 32% off handheld steamers, 45% against hand exercisers. This is the kind of stuff I'm revealing way too much about myself. Yeah, exactly.
Is that what bears like?
Yeah, gold bars.
Yeah, exactly.
Yeah, exactly.
Yeah.
You know, that's
that long life coffee and all of that stuff.
Yeah, those like, you know, emergency packs that you
seen
put
those
in.
preppers?
Yeah, totally.
Yeah,
that's what I'm saying.
Yeah, you know, I find that fascinating.
What are those meals called? Where it's sort of like the forever bar that you can eat that can give you some sustenance?
I forget, but they're pretty gross.
Have you tried them?
No, I don't want to either.
Okay.
Let's hope we're never in the circumstances where we have to eat that stuff, all right? Coming up on the programme, Nancy Lazare of Piper Sandler as the pressure builds on Fed Chair Jay Powell. Plus, Yahira Anand with your morning movers and a big deal for Big Pharma. Live from New York, this is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The opening bounce 16 minutes away. Equity futures positive by 0.2%. A struggle to bounce back from Monday's trade-related losses, but a mild day of losses in yesterday's session. A small bounce on the NASDAQ 100 up by 0.2. In the bond market, 2-year, 10-year and 30-year. A focus at the front end of the curve and the big Fed debate. Yields higher by a single basis point at 390.32. Further out along the curve, a big conversation about the prospect of inflation firming, plus what could it mean if you get a Fed chair that comes along and does exactly what the president wants long before the data demands it. Will that contribute to higher long-end yields? This morning, 441.52, yields higher for a sixth consecutive session. We're higher by another 2 basis points. That's the cross-asset price action. Let's cross over to Yahira Arnott for some single names. Hey, Yahira.
Good morning, John. We start with some big news in the pharma space, some deal news that we did talk about earlier, but now it's official. Merck has agreed to buy the UK biotech Verona Pharma for about $10 billion. So as a result, take a look at Verona Pharma. It is up more than 20%, and it's a strategic bet for Merck on respiratory medicine at a time when it's trying to diversify. That's because its top-selling cancer drug, the patent on its top-selling cancer drug is expiring soon, so it is looking for ways to offset that. Next up, we have a really big mover in our X-Site. Shares are down nearly 50% now. That's because the company, which makes lenses used in cataract surgery, slashed its 2025 forecast by $55 million. A big shock to investors, as you can see, and it's spurring a number of downgrades this morning. And we end on Starbucks, rising 3% now on our reporting that the company is considering selling a bigger stake in its China business. That's a shift since Starbucks had originally planned to keep a tight grip by only selling a minority stake. But with sales struggling and competition heating up in its second biggest market, we're reporting that it is sifting through offers and narrowing down a list of potential investors to try and make a deal. John?
Yahira, thank you. Thanks for this morning. Appreciate it. Let's get to the day ahead. It looks like this. Fed minutes later on this afternoon, another Treasury auction at 1 p.m. Eastern Time. $39 billion of 10-year notes. With the latest, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. I think today probably the Fed minutes will get some attention, but given the fact that the president is going to be releasing more tariff letters today, by the time we get to the Fed's discussion of what they were thinking 3 weeks ago, it may be mostly irrelevant, although people will be looking to see what the discussion was about why they kept 2 rate cuts in the forecast for the year. As far as the 10-year, the question has been, are we going to see some sort of buyer's strike by people from overseas who are unhappy with the United States? And the general feeling on Wall Street seems to be not yet, that there's enough demand out there. There might be a little supply concession, but overall, there's still demand for 10s. And any real movement based on what the president is saying about Jay Powell and others would really occur at the 2-year level for the moment.
Mike, any thoughts on the Fed race? Kevin Walsh versus Kevin Hassett, and whether we're seeing some auditioning already on the FOMC?
Oh, I think there's been auditioning, definitely auditioning. I think that Kevin Walsh is probably the favorite still. Kevin Hassett, very loyal and probably seen as the guy who would push for lowest rates. But what kind of reception would he get on Wall Street? That's something that Scott Bessent is going to be have to be weighing when he gives advice to the president about this, assuming that Mr. Bessent isn't putting himself forward. And then the question that they keep raising is, what if Jay Powell doesn't quit as a governor? They would only have 1 seat. They'd have to put the new chair into the seat that comes up in January. And so does that mean that maybe they keep Chris Waller in reserve just in case they can't get somebody else?
This could get messy. Mike McKee, appreciate the update. Looking forward to your reporting throughout the day. Michael McKee there from Jackson, I believe. Over at an economic forum over there?
Yeah, they do a lot of economic forums in Jackson, Wyoming, evidently.
Why not? It's any excuse, right?
You know, can we just separate out the drama and have that sort of like, you can watch the melodrama if you want to, but then watch paint dry over here, which is the actual policy, which is going to depend on all this economic data that's going to come through the fore. I think that would be great.
We'll do that right now.
Okay, cool.
If you want. Nancy Lazar of Piper Sandler with this to say. Investors might be done with tariffs, but we doubt Trump's tariff agenda is done with investors. Nancy joins us now for more. Nancy, good morning.
Good morning.
What is guiding you at the moment? What convinces you of that?
Well, to be sure, this administration wants higher tariffs. They've already put in higher tariffs, and they're going to stick. We've accepted the fact that tariffs are here to stay. Why? We do need a freer trade backdrop. And two, I think misguided, this administration thinks this is positive for the United States. I'm a free market economist. Tariffs are a bad idea. Nonetheless, I have to accept that they are indeed here. and they're going to be a negative impact on the economy. It's a regressive tax on consumers. Lower-end consumers are going to get hit more because of these higher prices, and same for small and medium-sized businesses. Larger businesses might be able to plow through this, but the smaller, medium-sized part of the economy are going to get squeezed from these higher prices.
When you take the politics out of it, is this more inflationary or more of a slowing growth type of ramification from the tariffs?
Well, near term, it's a tax. It's a hit on the economy. Whether or not it turns into sustained inflation depends upon what both monetary and fiscal policy do. I would worry about the Fed stepping in and cutting rates too aggressively here, because that would just increase the odds that these price levels indeed stick. When you've seen tariffs before, when we had some back in 2018, it was a price shock. You saw it in furniture, household appliances. You initially had that increase in price, but then you had a decline in demand, and that eventually led to a lower prices actually for household appliances and furniture. So it depends how sustainable these are on what the Fed does.
I want to just hone in on something that you said. If the Fed cuts, you think that would lead to more protracted price increases and more sort of entrenched inflation. What gives you the confidence to say that at a time where we're seeing on the margin some slowing in consumer spending and certainly deterioration in consumer confidence?
Well, as we saw, and this is nowhere near as extreme as we saw during the COVID crisis, you can have a temporary shift down in demand. But inflation is a function of what the Federal Reserve does, monetary and fiscal policy does. So even though you had that shift down in demand in 2020, because both monetary and fiscal policy eased so aggressively, you then had price levels stayed elevated with that supply chain disruption, and then you had the inflation in 21 into 22. So near term, yes, we are having a shift down in demand. Which could lead to lower prices, say, later this year, next year. But if the Fed were to cut rates too aggressively, then I would, again, be worried about inflation in 2026. And I thought your point on the bond market here is going to be really important. The Fed cut rates last year, 100 basis points. Everyone seems to forget about that. They cut rates 100 basis points in the fall of last year. What did bond yields do? They rose 100 basis points. So the Fed controls the short end of the curve, and I think some of the administration understands that, but they have to be careful of the long end.
Will the Fed have enough information to cut by September, given the fact, especially that the tariff deadline has been pushed out to August 1st?
I worry about that because we saw that the employment report on the surface looked healthy. Underneath the hood, it was actually a weak employment report, but on the surface, it looked healthy. I would have thought it would have been easier for the Fed actually to have cut rates here in July, where you really still have tame inflation and signs of an economic slowdown. I worry by September. You could have maybe clearer signs of a weaker economy, but stickier inflation. I am hearing from retailers that they're done with inventories. The pre-tariff increase in inventories, they're fading. Now they are going to be selling these higher price products in the third quarter related to the tariff increases. So I worry about September.
But a cycle or one price adjustment?
Again, for right now, it's a one price shift up in price, as we saw in 2018, but we don't have the conclusion. It depends upon how aggressive the Fed is.
When you say you're worried about September, are you worried about the price side of things? Yeah. Or are you worried about what could happen to the labour market if they have to absorb some of this on margin?
Well, I think you're going to increasingly hear stagflation as you go through the third quarter, because already you're seeing consumer spending stalling out. Already, again, under the hood, the labour market is deteriorating. Unemployment claims are probably the easiest number to show that, cleanest number to show that. So I worry that as you go through the third quarter, the Fed is going to have to really balance it. On one hand, you will have a weaker economy. GDP growth, we have less than 1% in the third quarter, probably a higher unemployment rate. But then the inflation data could be also more sticky, and you're seeing it in the data. Shelter was a headwind to inflation in the second quarter. Is that going to continue into the third quarter as these tariffs make their way through into the data?
And that's, as you know, there's a range of views at the Federal Reserve. This FOMC is incredibly divided. One view, I think is quite important at the moment, is Governor Waller's view. And Governor Waller is making, I think, a credible argument to say you should look through the inflationary effects, potentially, of tariffs, and maybe think about reducing interest rates. Do you find that particularly compelling?
I don't. One, I think if you look through the tariffs in aggregate, the economy actually is on a healthier footing. This is a soft patch. Volatility created from the uncertainty and the tariff and the price increases. As I've said before, and I focus a lot on capital spending, you have incremental fiscal stimulus for 2026, importantly for capital spending, which has boosted potential GDP growth already. You don't need a lower interest rate environment, as some of you have reported this morning. There's a lot of liquidity in the markets. That's why this M&A cycle is picking up, and I would be leery in cutting rates too aggressively. One, the economy is healthy with stronger potential GDP growth. We have basically a 4% unemployment rate. Cyclically, it's going to go up a little bit, but we don't need lower interest rates. This is not 2008-9. It's not a COVID crisis. I think rates should stay where they are.
So, John, I was thinking as Nancy was talking, if you wanted to explain stagflation, there is one economist, Donald Trump, who really put it perfectly when he said just a few months ago, maybe you need just $2 that cost a little bit more rather than 30. And maybe that's what we're seeing trickle out into the economy.
Is that the argument he's making now?
I don't know if he really wants to go back to that.
Don't hear quite the same thing.
Maybe not. I do wonder, though, about where the inflation comes from. If you do see consumers in not as strong of a position, you pointed to the labor market and the weakening that we're seeing in certainly the private payrolls report. Where is it going to come from in terms of fueling the ongoing ability to absorb the price increases?
So it will have to come from stronger corporate profits. I mean, because if you have a stronger corporate profit backdrop, then you'll get a stronger labor market, you'll get bigger wage increases. And so near-term profits are under pressure. 2Q earnings are probably going to decline, not year over year, but sequentially, which is why you have this weaker labor market. So you need this soft patch to end, which we think can end on its own without lower rates in 2026. Because of this incremental fiscal, and importantly, because of the capital spending cycle. And so the investment cycle fuels productivity, productivity fuels profitability, and that then net is how you get a stronger job market.
Nancy, we hope you're right. It's good to see you.
Thanks for your time.
Thanks for dropping by. Thanks for your time. Nancy Lazada of Piper Sandler. Equities at the moment positive by about 0.2% on the S&P, with an update on stories elsewhere with your morning brief. Your Bloomberg brief. Here is Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump said he will push forward with a 50% tariff on imports of copper into the US. The announcement sent copper prices plunging in the global benchmark. Trump is looking to spur more mining and smelting stateside, and the tariff can be in place within weeks. Elsewhere, a leadership shakeup at Apple. COO Jeff Williams is retiring from his post later this year, with plans to continue to oversee the design team and to manage health initiatives. 30-year Apple veteran Sabi Khan will replace Williams as COO. And Tesla CEO Elon Musk telling Wedbush analyst Dan Ives to, quote, shut up in a post on X. His comment coming in response to Dan's call for Tesla's board of directors to get involved after Musk unveiled his bid to start a new political party. And that's your Bloomberg Brief, John.
Lizzie, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead, plus Leslie Falconio of UBS as investors face President Trump's latest tariff threat. From New York City, this is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Bring you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Mild gains so far this morning, positive by 1/4% on the S&P, on the NASDAQ up by 0.2%. The day gets busier as the session grows older. Your day ahead looks a little something like this. 1 p.m. Eastern Time, the US Treasury auctioning $39 billion in 10-year notes. 2 p.m. we get some Fed minutes. On Thursday, we'll get Delta earnings, so look out for that, alongside some jobless claims and another auction, this time 30-year notes. The focus on economic sentiment results from Delta Airlines tomorrow morning. Leslie Falconio of UBS writing the following. U.S. consumers and businesses increase spending in advance of actual and threatened tariff increases. That boost is now fading and will begin to drag on growth in the second half. Leslie joins us now for more. Leslie, thanks for joining us. Just to build on that particular quote there, where do you expect to see that show up and how soon?
Well, I mean, we're expecting in the second half, probably not. I mean, obviously the GDP in the second quarter is going to be strong. We're going to start to see probably some slowing growth in, the third and fourth quarters, simply as we've had a pull forward in both businesses, and consumers. So our expectation is that the Fed does cut in September, twice this year, but for a total of about 100 basis points. So we're looking for about 25 basis points consecutively each meeting starting in September.
Some debate at the moment between a lot of people as to whether they should price the recovery in 26 off the back of the rate cuts that we might see from September onwards, or the slowdown that you're forecasting for the second half. Which one?
Well, listen, I think it's a sequencing issue, right? I think people are focused on tariffs right now and the cost that tariffs will have in terms of consumer and, therefore potential inflation. But in 2026, it's going to be more about tax cuts. So I think it's more about a sequencing issue. And if, in fact, growth does slow, again, not collapse, we're expecting these non-recessionary cuts, and you have some stimulus in 2026, you could see an upward trend growth. And I think that's what the market's paying attention to.
One of the big challenges here is the inflation picture, and we're saying this ahead of next week's CPI report. I'm looking right now at five-year break-even rates, basically the expected inflation over the next 5 to 10 years as baked into derivatives. And it's actually at the highest level right now, going back to February. And I just wonder if the Fed has the bandwidth to cut rates the way that so many people are expecting, including yourself, given that there is this fear that is percolating into certainly markets, if not into what we're hearing from retailers.
Listen, there's no question, and you've talked about this before, and I happen to agree. If the Fed does cut prematurely, you do run the risk of that back end moving higher, and you have this really large bear steepener. But even though the five-year inflation might be up a little bit, it's still very well anchored. And when you look at some of the components of service inflation, I know we've been focused a lot on goods inflation, but if you look at some of the components of service inflation within, say, the CPI, OER year over year is down. Auto insurance year over year is down. So there are these service inflation components where you haven't seen this really large spike. But to your point, Lisa, it's definitely something that the market is going to be watching. And there's no question that market perception, if the Fed does cut too early, is going to react before the actual fundamental data is shown. And that's really the risk that the Fed faces right now.
So at 1 p.m., we've got $39 billion of 10-year bonds being sold. And then tomorrow we have $22 billion of 30-year treasuries also being auctioned off. How closely are you watching the internals, the dynamics, to understand just exactly what the zeitgeist is in markets that could drive action and potentially even your strategy?
Yeah, I mean, look, we're watching the 10-year auction today. We do expect some concessions. There's no question. It's not, just because we've had some, renewed tariff headlines and maybe this is, will increase inflation going forward. But a lot of this has to do with the fact that we had a strong jobs report. People came into that job report, I think, long duration. They had to shed some. So I do think we are expecting some concession into the 10-year Treasury auction, but we still expect it to go well. And again, our, point on the curve since going back to 2024 has been to stay in the intermediate and that 5-year or the yield curve. And that's really worked out well for us. It's been a great hedge during those pockets of vulnerability in the equity market. It's had a great total return. And we're often asked, when would you extend? When would you move your duration out? Listen, it wouldn't be impossible or a small probability that we see the high of the 10-year Treasury yield that we saw in January around that 480. Would we start to extend and to have that buy the dip mentality? We absolutely do, but we're not rushing in.
Well, what would make you get there, though? Like, what could be the catalyst?
In terms of rising rates?
Yes.
Yeah, I mean, listen, it could be 1, the Fed cuts prematurely. 2, obviously, this inflation that we're seeing turns out to be a bit higher than what we expect. And when I'm saying that, it's not just having inflation come into the numbers, but how quickly it does. Right? If it's this gradual rise in inflation, then that's one thing, or if it's much quicker than what we're expecting. I mean, if you look at PCE projections at the end of the year at about 3.5%, you still have to run a 3-month average about 4. So, I mean, in those kinds of, numbers, I think would really move those yields higher. I don't believe it's deficit driven. I've said this before on your show. I think, supply is a passenger, not a driver. It's about inflation and growth in that long end. But if you do see something that inflation's coming in faster, right, than what people are anticipating, then you could get it.
You said earlier the market right now is focused on tariffs, but next year it's going to be 2026 is going to be about the tax cuts. What tax cuts specifically? Because what we saw in the One Big Beautiful Bill in terms of the big chunk of the cuts, it's only an extension of the current policy we have today.
You're absolutely right. And I do think that, the market's perception of, I think, when we look at, especially if you look at 7% of deficit versus nominal GDP, if most of that GDP is already into the marketplace, and I agree with you, then I think what the market is looking at in terms of the benefit of terms of whether it's CapEx or the fact that it does believe that the Fed does cut, which should fuel growth. And I think that also no one expects third and fourth quarter growth to be, incredibly high. Even though we're looking at a 1.5% GDP in the fourth quarter, those third and fourth quarter numbers are going to be below trend. So I think you're going to have that upward slope in terms of that growth outlook in terms of 2026 as well. But that is the risk. There's no question.
Leslie, appreciate your time. Leslie Falconio there of UBS, looking ahead to a whole bunch of risks in the second half. Look at this right now. Peter Navarro, trade advisor to the President of the United States, saying Apple thinks it's too big to tariff. Apple just moments ago turning negative in the pre-market, down about 0.2%.
Yeah, this just points to the idea of you have to be in the good graces of this administration. If Apple was looking for a carve-out, Peter Navarro isn't the one that's going to give it to them, and they aren't going to be the one to really signal it either. I do wonder how much the president is going to pit himself against the tech giants that have gotten so much of the preeminence in U.S. equity
And
markets.
what's interesting is because everyone says India is going to be that deal that the president announced in terms of a framework that's imminent. What have we seen over the past few years when it comes to Apple, moving supply chains out of China into India, potentially they're going to be hit with a rate that's going to make it very challenging for them. And Peter Navarro, he's not at the negotiating table, but he is very close to the president. He goes in and out of the West Wing, and he has the president's ear, and he's saying that maybe Apple is going to be one the president looks at next.
Apple is not having a good year so far. The stock is down by about 16%. Tariffs is one story. Meta going after their talent is another story. Here's one more. This from Peter Navarro. The Fed should cut rates in July.
This is my shock face.
Who hasn't said that in this administration?
This is sort of the on-point message that you have to put out there. They're too late. It's too late, Powell. Not even too late, Powell. It's just too late. That's his name, TL. And, you know, he needs to go now. I guess there is a growing number of people in markets who agree with them. It's the argument that they make and how salient that will be, because if it is about the deficit and lowering costs, that is not going to resonate well with markets versus a discussion about slowing inflation and a lack of inflationary pressure coming from the labor market.
Neil Dutter of Renmark just moments ago saying that Trump has created a litmus test for his Fed nominee. They have to agree to cutting interest rates. This makes nearly all of the potential candidates look totally compromised. Went on to say this: if Trump values feeling the market, he may end up having no choice but to pick Governor Waller, an argument that Neil's made a few times.
You need the credibility in order for the Fed, to your point that you said earlier, to have the ability to cut rates, because ultimately it depends on that credibility that they will be willing to hike rates if there is a problem with inflation.
We've all said this repeatedly. There will be two votes, one at the Senate, and before it gets there, one in this market. And this market will vote very quickly about the credibility of whoever the candidate is. Coming up on the programme tomorrow, the lineup looks like this. Liz Ann Saunders of Charles Schwab, Mike Zezas of Morgan Stanley, Holly O'Neill, the president of retail banking at Bank of America, and Oksana Aronoff of JP Morgan Asset Management, plus a special guest, the former US Vice President, Mike Pence. Live from New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Let's talk about this villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, a change during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human being, for the world.
The incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why. But we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg. All right, we are looking at futures rise. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, no more extensions. President Trump vows there will be no more delays in his tariff agenda come August 1st. And turmoil in metals markets. Copper whipsaws as the president announces a massive levy on imports of the commodity. In the world of tech, Apple's chief operating officer is out, and Meta's AI vision gets sharper as SpaceX's valuation soars. A lot going on in this market today.
Absolutely. From tech to health we go, because we have some M&A. Merck buying UK biotech firm Verona in a $10 billion deal. Merck, as we know, is working to offset losses from that 2028 patent expiration of its blockbuster cancer drug Keytruda. As you might expect, you have Verona shares absolutely flying pre-market of about 21%, but also Merck shares up slightly as well, to the tune of about 0.8%.
Investors like that deal. Also watching copper-related stocks. Freeport-McMoRan, for example, right now up a little bit more than 1% in the pre-market after President Trump announced a 50% import tariff on that metal. And we'll be watching especially any of the smaller companies that produce right here in America, Katie.
Well, on that note, President Trump now says that he will push forward with his tariff regime with no more extensions, just one day after hinting that his August 1st deadline was not firm. The president then turned his attention to two very specific industries.
I believe the tariff on copper, we're going to make it 50%. We'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%.
All right, let's get the state of play from Bloomberg's Washington correspondent, Tyler Kendall. So no more extensions after August 1st, although people, Donald Trump says they're on copper, I guess, have a year and a half to come in?
Yeah, hey, Matt, exactly. So we are waiting for potentially these sector-specific tariffs to come down the pipe. We were expecting that they were incoming, considering that this is going to be invoked under Section 232 on the grounds of national security concerns, which meant that the administration had already launched an investigation looking into copper back in February, and then pharmaceuticals, the second sector-specific tariff that President Trump said to expect. That investigation was launched back in April. Now, typically it takes 9 months to get these underway, but it is clear the administration is working on a little bit more of an expedited timeline here, and it's really only going to complicate the negotiations on the so-called reciprocal tariffs going forward, because even though these are tariffs enacted under separate provisions under the law, they are becoming really integral in the conversations, including when it comes to the European Union, for example, which President Trump said could expect a letter in the next 2 days. He said that there will be a wave of tariff letters incoming. We could expect a minimum of 7 countries to receive them this morning, and he said a second batch will be coming later in the afternoon.
All right, Tyler, appreciate the update. That is Bloomberg's Tyler Kendall giving us a lay of the land here. Let's talk specifically about copper, because the president's 50% tariff threat is already impacting the price of copper. You have one Jefferies analyst saying, quote, that the U.S. does not have nearly enough mine, smelter, or refinery capacity to be self-sufficient in copper. Let's discuss now with Joe Doe, who covers the space for us. You had Citigroup also calling this a watershed moment. What do we know so far, and what does the reaction look like?
What we know is the president has said he's going to put a 50% tariff on copper. Don't know what copper, don't know which products, don't know how high or down the supply chain they go, and that the market had a massive reaction when he made the comment. We've seen prices pull back in both the futures traded here in New York and the LME, which is typically the benchmark globally. But we did see prices spike as much as 17% yesterday. I mean, I've covered copper for over a decade. Like, I've never seen that kind of a spike in a price in a one day. So where we sit today is everybody in this market is wondering, what are the details? What are we actually going to get? Howard Lutnick, the Commerce Secretary, said, well, it's done and we're going to get this out, and you'll probably see it in a Truth social post or something like that. We haven't seen anything yet. The market does want detail. There are questions around this, like, is it copper cathode, which is like raw copper? Is it copper products like semifab and others? Is it pipes? Is it copper wire? I mean, copper wire is a massive, massive industry in this country because electric grids, everything, right? So everybody's wondering where the price is actually going to be on the tariff.
And when? Also, because we're going to talk to John Wobensmith later, who runs Genco, a shipping company, and I imagine he has clients calling him saying, like, can we send over some copper now, right?
Right, exactly. What we did see a few months ago when we reported that President Trump was speeding up the 232 process on copper, we saw an ARB window open up. People were rushing to get copper into the United States, anticipating that the tariff would come on earlier than expected, which meant, hey, let's get this in before we have to pay a higher price. Presumably, you're going to start seeing the same thing now that we're starting to get closer to this actually happening. But I think the question is, like, how much of that, right? Because this had already been happening. The market has been expecting a tariff to come in. I think maybe the big surprise here is that number, 50%. A lot of the market was kind of waffling with maybe it's going to be 25%, maybe it's going to be 10%. They didn't know. But now we have the President of the United States actually giving a number. So we could see that affecting the actual trade flows for the near term.
All right, Joe, look forward to talking more about this with you over the next year and a half. Joe Doe covers metals for us. He's also our economic statecraft czar, so to speak. The president threatening a 200% tariff on pharmaceuticals imported into the U.S. 200%. That threat sending European pharma names into the red. For more, we're joined by Bloomberg's health reporter, Damien Garde. So, Damien, what do we know about the details of this tariff threat?
Well, very little. And in fact, despite the terror, I think, that might be incurred by that 200% number, this disclosure by the president was greeted with some relief by analysts in the pharmaceutical sector because he mentioned that this would be 1.5 years, this kind of vague deadline in the future for which companies would have to bring more manufacturing to the United States. As you might know, many major pharmaceutical companies have been kind of tripping over themselves in 2025 to announce plans to build manufacturing capacity in the U.S. for drugs that they currently import from elsewhere. And so there is, maybe reading between the lines, a notion that Trump's earlier rhetoric about imposing tariffs almost immediately on the pharmaceutical industry, because that has evolved to this kind of like nebulous distant date and this 200% number, that perhaps those companies have succeeded in coming to the White House and saying, look, we can't overnight just start making complicated injectable drugs in North Carolina that we currently make in Switzerland, but here's what we will do. And this is perhaps a sign that that has gotten through to the administration and that they've bought themselves some time, if not kind of escaped some of the crosshairs that had been on them previously.
Yeah, in some ways, there's parallels to the conversation we were just having about copper mining, that there's just not the capacity as it stands right now to have all this production in the U.S. But Damien, I actually want to get your thoughts on another story in the health space, and that is the M&A deal that we saw this morning with Merck agreeing to buy Verona for about $10 billion. We know that Merck has been shopping around, that they have that patent cliff coming up, and it seems like they've found their answer here.
It does. I think what we're seeing, as you mentioned, Merck's patent cliff is that they currently make the best-selling drug in the world in the form of Keytruda, a medicine for many, many types of cancer. It will soon lose its exclusivity, and Merck will have a roughly $30 billion, $40 billion hole to plug in its revenue. They know that there is no one, they're taking kind of a Moneyball approach, I suppose. They know there's no one product that can recreate the effects of Keytruda on their revenue, so they are looking to recreate it in the aggregate, mostly through a series of deals and through their pipeline. So that enter Verona today, which has a recently approved treatment for COPD, emphysema, and other kind of related conditions, that has peak sales estimates in the mid-single-digit billions out into the 2030s. And that is the kind of like single or double that a company like Merck needs in order to prepare itself for the loss of Keytruda's patent life.
Hey, Damien, great to get your take on this. We're going to be digging deeper and deeper, obviously, into this issue over the next few weeks and months as well. Damien Garde there covers healthcare for us here at Bloomberg. Coming up, Sam Altman and Mark Zuckerberg are poised to reunite in Sun Valley, but their fit their fit is going to be much cooler than we're showing you in these pictures. You got to see the glasses Sam Altman is wearing, and I'm looking forward to a pendant over Mark Zuckerberg's turtleneck sweater. Later on, don't miss a conversation with White House Council of Economic Advisors Chairman Stephen Myron. In our next hour, we'll ask him about the effect on tariffs after the big, beautiful bill was signed on the 4th of July. This is Open Interest.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi Zahran, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Let's get out of high interest. Look at what's making headlines around the world. A Rivian-backed startup that's developing smaller EVs is getting valued at $1 billion right now in a new investment from Green Oaks Capital. The company, called Also Inc., was spun out of Rivian earlier this year. Also hasn't revealed specifics, but said its tech platform will be applicable to e-bikes and microcars, as well as neighborhood EVs, whatever that is. Mobileye is reporting preliminary second quarter results that beat expectations. It also announced, though, a secondary offering by Intel. Bloomberg Intelligence says the results reflect a stabilization in global auto production, and the offering likely reflects Intel's cash needs. And tech titans are converging in Silicon Valley, Idaho, for the annual Allen and Company conference, an event where billionaires and CEOs rub shoulders and strike deals. Our own Ed Ludlow is there, and he caught up with OpenAI CEO Sam Altman, who said he's looking forward to meeting with Meta CEO Mark Zuckerberg. The pair haven't spoken since Zuckerberg poached some of OpenAI's top engineers. Ed asked Altman his thoughts on AI talent recruitment.
I think we have an obviously we have an incredibly talented team, and I think they really love what they're doing. Obviously, some people will go to different places. There's a lot of excitement, I guess we could say, in the industry, but no, I think we feel fine.
So that's one feud that's happening right now in the tech industry, which we're going to get to. But let's get to another feud that is underway, and that is Elon Musk responding to longtime Tesla bull Dan Ives. Now, yesterday, the analyst posted recommendations for Tesla's board to consider for Musk when it comes to his divided attention, when it comes to politics and what's actually going on with the business. What did Elon Musk say? He said, "Shut up, Dan." And that, of course, is Tesla's biggest bull on the sell side. Let's discuss with Bloomberg Tech co-host Caroline Hyde. So we're highlighting this because this is having a real impact on Tesla shares, this overarching concern that we have a distracted CEO and he's just getting deeper and deeper into politics and not focusing on some of the fundamental issues that are going on at Tesla.
The issue is Elon Musk has always given very short shrift to analysts, to the shorts out there. He's not afraid to bite the hand that feeds. Dan Ives is the hand that gives it a price target of $500. Biggest bull on the street, actually saying give 25% voting control to Elon Musk. Was Elon say, shut up? So, I mean, it's an interesting tete-a-tete, but we do see the ongoing concerns that we have a more distracted CEO. Also, a guy who's busy launching an updated Grok later tonight. So he's busy doing that. Grok getting a lot of flack today with some seemingly anti-Semitic commentary happening on the chatbot. You've also got the guy out there raising money for SpaceX. Ed Ludlow breaking the news that it's now going to be worth about $400 billion. That's the most valuable US startup out there, as it raises a little bit more money, but ultimately makes more liquidity for those who've been working there. I think that's a real signal that people are still willing to back Elon Musk and Elon Inc., even though he's busy having a feud with the President of the United States.
It's a good reminder that we've always had these conversations around Elon Musk. He's always been in charge of several different companies at one time, and the SpaceX share sale is a great example.
Yeah, I mean, Kathy Wood was on, I think, surveillance yesterday saying that she's not worried about Elon Musk being distracted, but he has got a lot to do. I'm waiting to see what Mark Zuckerberg wears to Allen & Co. Like
glasses, right?
Those Varnays that Sam Altman was rocking are truly, I mean, Mike Judge needs to come back and make another Silicon Valley with these characters. They're just amazing.
And where are the cameras and where is the AI infused into your Varney glasses? I thought actually Sam
Altman... Oh, the Meta investment, right? Another $3.5 billion into Luxor.
Yeah, they're taking now a 3% stake in the maker of Ray-Bans and Oakleys, who make their smart glasses. They could ultimately take about a 5% stake, according to people familiar. This is them betting big on ultimately the share price improvement in a company that they've anointed to build their technology of the future. Interestingly, I thought Sam Altman was on fighting form today, and well, yesterday when he arrived at Sun Valley, also saying that, look, watch this space for our hardware. So that was the last question that was thrown at him. And they were like, what about your hardware with Johnny Ives? And he was like, it's going to be great. But at the moment, he's wearing Varnays. But he's certainly not wearing Meta glasses. I'm pretty sure Zuck will be.
Yeah, and I thought that Meta investment was really interesting because you also saw Warby Parker shares rise yesterday. Warby Parker, of course, wasn't the target of the investment, but maybe some speculation that we're going to see more of these matchups in the future.
And you've already seen it. Alphabet, Google's been getting closer to Caring Group with its glasses. We're likely to start to see more and more companies come out with this new way in which we interact with AI. It's not going to be augmented reality. That's a step too far. The Vision Pro ultimately was too pricey and not the form factor we need. But we do want to have AI in our intermediate lifestyle, and that's going to be with the sunglasses, it feels like.
We should remember, so far, Meta has invested in EssilorLuxottica, and they own both Ray-Ban and Oakleys. And those are the two brands that have been infused with this technology, right? Varney is actually owned by LVMH, so it's a completely different...
fashion.
Well, owner, right? So Meta is only making glasses with the brands that are owned by Luxottica.
Yeah.
It's not like they're going to branch out and do something with a different brand that's not owned by Luxottica.
What are we trying to signal as to who OpenAI is getting into bed with? We know that they've got this partnership with Johnny Ive. We know that they've got some legal ramifications with that. And so we'll see who they particularly work with. I'm
so fascinated to see what Johnny Ive and Sam Altman come up with, because the thing about Apple is they really don't need... I know Dan Ives was out with a note today saying they have to make an acquisition, and he's saying perplexity is it. But as long as they own the hardware with which we use AI, it's okay. But if Johnny Ive and Sam Altman come up with something that makes you no longer need an iPhone, then Apple has a real problem.
But then also look at the changes that are currently happening at Apple. We've just had the yet further scoop that the COO, Jeff Williams, who'd been there running the COO role for at least a decade, saying goodbye. At one point, we thought he might take over from Tim Cook. They're basically the same age. But the guy who comes in instead, Sawi Khan, he's been there for 30 years. These are people who know the business well. We're likely to see the hardware engineering guy get anointed potentially to take over Tim Cook. That's what people have generally thought. But this is a shuffling of the deck. The people in charge of supply chain here are all being regalvanized. And look, you have the latest tweet out, comment out of Peter Navarro, who's there very much trying to dictate where trade deals go, saying, Apple thinks it's too big to tariff. That's the headache for Apple right now. Is that the distraction for that company rather than innovating in AI? You've got Tesla CEO distracted with politics, and you've got Apple distracted being forced to think about politics.
All right, Caroline Hyde co-anchors the Bloomberg Tech Show. You can catch her with Ed Ludlow at 11. He'll be like lurking in the bushes somewhere at Allen & Co. Talking with a billionaire CEO, but I'm sure present on the program. Coming up on this one, we've got a wave of share sale announcements overnight, including, this isn't one, but interest in the Chinese business of Starbucks and other potential companies on the block. Details ahead right here on Open Interest. Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Welcome back to Open Interest. A check on the setup when it comes to the futures market ahead of the opening bell, just about 7 minutes away. You can see we're up slightly. We had pretty much an unchanged finish for the S&P 500 yesterday with some big intraday volatility. Right now, as it stands, we're about 0.3% higher. Same story if you take a look at the NASDAQ 100. Your big tech names that live there also up slightly. Small guys are winning today. The Russell 2000 up about 0.4%. Probably helps that you have bond markets cooperating a little bit this morning. The 10-year Treasury yield down slightly below 440. Matt Miller.
All right, so overnight we saw a wave of stake sales, share sales, takeover interest from companies like Bank America and Starbucks. Those are the sellers in this. Let's get details from Bloomberg's cross-asset reporter, Isabel Lee. And I should say potential sellers, right? These aren't done deals. There's a lot of speculation here, but I want to start with AES, an energy company with an enterprise value of $40 billion.
It does have that enterprise value, and its market cap is only around $8 billion. So it's a power from AES, and it's exploring options including a potential sale. That's according to people familiar with the matter, and you see shares edging higher by just around 2%. So AES provides power, renewable power, to tech companies like Microsoft, Google, Amazon, and investors including Brookfield and BlackRock have really been studying their shares after they lost half of their value in the past 2 years, of course, due to Trump's anti-renewal policy. So AES, again, to your point, has an enterprise value of $40 billion, which will make it one of the largest leverage buyouts that would rank of all time.
And you can see shares just flying right now, up about 17%. I just want to talk about Starbucks and what's going on with the China unit, reportedly drawing interest for a potential controlling stake here.
Yes, you and I like Starbucks, so shares are also edging higher by nearly 3%. So China is the second biggest market of Starbucks, and Bloomberg reported in May that it is exploring potential review of its company. So now Starbucks is in the process of reviewing those and really shortlisting candidates for a next round of bidding. And this isn't really Starbucks' preferred option. I think that's important to note because they preferred a minority stake that will help them grow their business. But now here we are. And Starbucks really has been struggling in China, and they've tried to cater to local tastes. So they've slashed tea prices. They've made 0 options for coffee. We'll see if it's working. But really, they've tried to attract more consumers there.
0 options for coffee?
No, 0 sweeteners for coffee.
Ah, okay.
Maybe I said it wrong. Did I say it wrong or you heard it wrong?
No, 0 sweet. I guess like no sugar options.
No sugar options.
Bank America, Kuwait.
So Kuwait.
Have they lost faith?
Yeah.
No.
That's too strong of
In
a
30
statement.
seconds.
Okay, so it's a $1 trillion sovereign wealth fund, and they sold a $3.1 billion stake, according to people familiar with the matter again. So the sale was handled by Goldman Sachs, and they saw it's 1.5% discount to Monday's closing price. I think the most important thing here, it follows Warren Buffett's Berkshire Hathaway's retreat. So Warren Buffett was seen as a white knight, and now they sold out. And we have Kuwait Investment Authority also doing the same, and their backing goes as far as 2008. So that's really
all right. Great roundup, Isabel. That is Bloomberg's Isabel Lee. Stick with us. The opening bell is up next. We'll walk you through the action with Seema Shah. This is Bloomberg.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in.
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
We are just seconds away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. You're looking at futures that are pointing higher after kind of a flattish close yesterday. 62.94 on the futures. On the cash trade, we're still about 50 points away from the all-time closing high that we hit on last Thursday. NASDAQ futures up a little bit more. Russell, the small caps, up more than 0.5% right now. You hear the opening bells. On the New York Stock Exchange, you've got Arlo ringing the opening bells, and apparently they make security cameras and the like. I should know because the stock is up 542% over the past 5 years. They've been absolutely crushing it, and that's why they deserve to ring the opening bell at the New York Stock Exchange. Meanwhile, down at the NASDAQ, Avidity is a biosciences company, and their stock is up 7% over the past 5 years, so it's better than a loss, but I think they could do better.
Yeah.
I think they could do better.
All right, so if you're listening, Avidity, Matt Miller has some opinions here. Let's stay on health, though, because we have some M&A in the sector. Merck buying UK biotech firm Verona in a $10 billion deal. Merck, as we know, is working to offset losses from that 2028 patent expiration of Keytruda, and that has really been a big overhang for the stock. You can see Merck is actually up a little bit right now, Matt Miller, about 1.6%. Verona obviously is flying, but Merck down about 33% over the past year, which is a big loss.
It is a big loss, but it looks like investors are behind this acquisition. Today, we're also watching copper-related stocks. Obviously, after President Trump says the tariff could go up 50%, customers are going to rush to bring in copper now. You can see Freeport-McMoRan, the first name that comes to mind, up about 0.8%, so a gainer there. The smaller, I'm looking at Ivanhoe Electric, for example, which makes copper right here in the United States. It's a small company, just about $1 billion, but it was up 5% yesterday, another 3% today. Equity volatility in general is poised to pick up in coming months. Goldman Sachs strategist led by Christian Müller-Glissman write that, quote, a deterioration in tariff discussions remains a key risk, but fiscal concerns in the U.S. or U.K., potential French elections, and geopolitical tensions could also drive more volatility. Let's bring in Principal Asset Management Chief Global Strategist Seema Shah. And obviously, I don't care about the UK or France, Seema. Don't even know where they are. But the U.S. markets could see more volatility as these tariffs continue to be dragged out, right? August 1st is now the deadline, no longer July 9th. And the president says copper tariffs could come in a year and a half.
Yeah, and I don't think that even the 1st of August is going to be the end of the story. I mean, ultimately, if you look back through history, trade deals take a long time to take place. Even whatever is announced on August the 1st, there's still going to be a long way after that. So in that period, there's always going to be the potential for resumption of hostilities, and it's going to continue to be a negotiating tool. So from our perspective, tariff noise, that's something which becomes a permanent feature of the economic backdrop. It's really whether or not the market's going to continue to take notice of it. But certainly in the next month or so, given where equities are sitting today, there is some vulnerability in that near term.
Is there, though? Let's talk about that a little bit more, because you get these headlines out from, of course, President Trump, especially in yesterday's cabinet meeting. It just felt like a grab bag of different industries that were being targeted, from pharma to copper, et cetera. And it just feels like there's not too much reaction, at least in the overall benchmarks anymore, like there might have been a couple of months ago even.
Yeah, that's absolutely right. And I think one of the things is, to your point, is the way that it was always almost announced was a bit off the cuff. There's absolutely no details either. So I think the market is also looking at that. But at the same time, I think one of the factors that I think markets are considering is that when you're thinking about copper, 50% tariff could be fairly negative for the US economy. So is President Trump genuinely going to go ahead with that kind of number? I think it's fair that the market is questioning it and saying, well, look, in the past, every time that there's been a really meaningful threat to the economy, he has taken a step back. So potentially this is a negotiating tool.
I kid, Seema, about not knowing where France is. Obviously, I've lived in Europe for many years. And those benchmark indexes have really crushed it compared to the S&P, right, which is up, what, 6% year to date. We're looking at, on the CAC 40, a 20% gain. On the DAX in Frankfurt, a 40% gain in, you know, if you're a dollar investor. How much legs do you think those European index rallies have? Or do you see a reversal here? Is the U.S. now going to play catch up and you can sell some European stocks and put those profits into America?
Well, look, I think in the near term, as I said, I think there is some vulnerability for the US, given that there's so much headline risk in the next month or two. But if you're looking beyond that, I think Europe is maybe getting to the end of this current rally, starts to lose some steam. That doesn't mean it's going to be reversed. But I think you're getting to the point where investors are looking at the fundamentals, they're looking at the earnings expectations, and they're saying that there's a bit of a mismatch. And we know, of course, a lot of it is driven by these hopes around what fiscal stimulus can do for the European economy. But we do know also that typically and historically, Europe has been a bit of a disappointment when it actually comes to implementation. So we're getting to that point where European investors are saying, look, show us the money, show us actually what is going to come through, when is it going to come through, and how is it going to be spent? And then, of course, there's a potential for a further run-up. But I do think at this point in time, you're going to see a loss in steam.
Well, we should probably get some more clarity when it comes to at least the corporate picture in the next couple of weeks. Earnings season is fast approaching. The big banks kicking us off next week. And bringing back the conversation on tariffs, there was a really interesting note from Deutsche Bank yesterday, basically estimating that there could be a 2 percentage point hit to S&P 500 earnings amid all of this tariff noise that we were just speaking about. When you run your own models over there at Principal Asset Management, do you end up with something similar?
So look, we do think the S&P 500, a lot of companies are definitely exposed. I think the key question for us at the moment, though, is when does that hit come? It's not entirely clear that it is even on the doorstep, given that there's been so much front-loading of imports in the last couple of months. And even from the Fed's perspective, this is really going to be key, is when do we actually see that data materializing? When do you see an increase in prices? And at the same time, we also don't know exactly how much companies are going to be able to pass on the price increases. So I do think that as the earnings season gets started next week, it's going to be really interesting to read through that forward guidance and hear some of the narrative that these CEOs are talking about and how they're seeing any implication from adjusting supply chains.
We're looking at NVIDIA. I just want to point out to viewers here, Seema, NVIDIA shares continue to march higher. It is the biggest point gainer on the S&P 500, and it's about to hit $4 trillion in market cap. Is this, continued march higher just inevitable, Seema? It doesn't seem like there have been really any big competitors able to unseat NVIDIA, even as, the Chinese continue to try and have to eventually come close, right?
Yeah, I don't talk about single stocks, but I can talk about just generally the technology sector, obviously driven by NVIDIA here, is that has been a discussion point which continues to drive markets. It lost a bit of pace earlier in the year because of the emergence of DeepSeek, but people are really continuing to buy into that general thesis, that kind of long-term narrative that AI is going to be the key driver of all productivity growth. We haven't seen that disappear. And interestingly, technology is actually the sector which is most exposed to tariffs because it has majority of its revenue outside of the US, and yet it's continued to outperform. So I think this gives us an idea that investors are looking through a lot of the tariff noise, and they want to see that narrative continue. So tech earnings next week, as the coming weeks go, is going to be absolutely imperative in order to make sure that beyond the next month or so, you do see these continued gains in US equities.
Absolutely. It feels like the stakes just get higher when it comes to tech earnings. Seema, great to have some time with you. That is Principal Asset Management Chief Global Strategist Seema Shah Let's get a check on some of these movers and the makeup of this market right now. You can see the S&P 500, it's in the green, and a lot of that comes back into NVIDIA. As Matt was just mentioning, we are closing in on $4 trillion for market cap. NVIDIA is your biggest points contributor to the S&P 500 right now, up about 2.2%. And that, of course, is fueling this entire market, though you do have the likes of Microsoft, Amazon, some of these other tech names certainly helping as well. You can see the S&P 500 up by about 0.6%. Let's take a look at the downside. There are more winners versus losers right now, but to the downside, you do have United Health Group down about 1.6%, Palantir, Apple, as we've been discussing, those woes continuing, and you can see that reflected in the single stock stories. But let's take a look at the sectors as well and see the makeup there. More green than red. Up at the top, you do have tech. Thank you, NVIDIA. Consumer discretionary as well. At the bottom, what's not doing too hot today, utilities, consumer staples, and energy, but small moves overall, Matt Miller.
Yeah, still so much news in this market that you can't take your eyes off it. Coming up, SpaceX is raising money and selling shares at a nearly $500 billion valuation, according to sources that have talked to us here at Bloomberg. We'll discuss that with the reporter who broke the story next. And in the next hour, we speak with Goldman Sachs Chief U.S. Equity Strategist David Kostin. He'll join us right before we get a chance to speak with the White House Council of Economic Advisors Chairman Stephen Myron. So a ton of news today and a ton of amazing guests that you don't want to miss. Keep it dialed in right here on Bloomberg Television.
Welcome back to the circuit. This time, we're taking you to the frontier.
Where is do we have a camera, or do we don't want to lose you, Emily, in all of this?
Stargate. Put that name down in your books.
What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week.
More than what you need to know, it's what you need to think about.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Wynn Resorts getting a downgrade over at Citi. The analyst says that he sees Wynn giving up gaming market share in Macau in the near term. Shares down slightly. Next up, we have T-Mobile getting a cut to a sell over at KeyBank. The analyst over there saying that the stock's underperformance will continue and that its premium valuation is still too high. And finally, we have Microsoft getting upgraded to a buy over at Oppenheimer thanks to AI upside. The analyst says that investors should embrace Microsoft as one of the long-term AI winners in software, Matt, and shares are up about 1.4%.
All right, let's talk about those people who are investing in this technology. Executives have descended on the Allen and Company conference in Sun Valley, Idaho. They include OpenAI CEO Sam Altman. He spoke with a gaggle of reporters about explosive growth in AI and tech.
I am a believer in technology and science and economic growth, and I think that I'm all for offering great services, and I'm all for figuring out ways to make capitalism super inclusive. But I think part of the thing has got to be we drive the country towards very significant economic growth.
The more I see those glasses, the more I want my own pair. Altman spoke after a Bloomberg scoop that SpaceX is discussing plans to raise money and sell insider shares in a deal that would value the company at $400 billion. That would make it the most valuable startup in the world. Bloomberg Tech co-host Ed Ludlow broke that story. He joins us now from Sun Valley. So first, on the SpaceX sale, give us the details, Ed.
Sure. Yeah, it's a mechanism that they've used historically, which is concurrently a very small primary, selling a small amount of fresh equity to set price and therefore valuation. But the main thing is the tender, secondary, right? Give employees liquidity, allow early investors to have some liquidity as well. And it's a big moment. There's been a lot of tension between Elon Musk and the president. SpaceX has great regulatory exposure as well as a lot of business exposure to the United States government and various defense apparatus. But it shows continued growth, both on the launch business and on Starlink as well.
I do just want to quickly mention NVIDIA. We were talking about it last block. Its rise continues, and it actually now becomes the first company to reach $4 trillion in market cap. So NVIDIA ascendant this morning, and really for the past couple of years, we'll continue to keep an eye on that. But when it comes to SpaceX, part of this rise in valuation, Ed, comes back to Starlink. So talk to us a little bit about what the state of play is there, because that has also come under scrutiny.
Yeah, I mean, over time, the proportion has shifted, right? Starlink becomes more than 50% of revenue. It's higher margin business. You know, the business of sending rockets into orbit, regardless of the payload, is never going to be a big cash cow. And SpaceX increasingly facing competition, Project Kuiper from Amazon, but that's where there's a lot of hope. You know, SpaceX, like many of Elon Musk's companies, it's so hard to get into. You have the biggest private growth equity names, largest venture capital firms, other technology companies, Elon Musk's close confidants and friends, other sovereigns. But the hope is that in the longer term, the Starlink bit will be spun off. There'll be either some kind of listing or opportunity for a broader investor base to participate. And that's part of the story here around the valuation too.
Ed, I can't look away from NVIDIA here. I mean, more than $4 trillion in market cap. I will never forget when you were on air and Apple crossed the $3 trillion mark. I have that phrase ringing in my ears all the time when I think about this climb in the value of artificial intelligence companies. And in a sense, they've left Apple in the dust, right? I know we use Apple devices for the OpenAI app, but Apple hasn't made any moves, really any big moves here. Dan Ives was out with a note this morning saying they should buy Perplexity. What's your thought?
I saw that. Yeah, I mean, what's so astonishing is that Jensen Huang's not here, right, in Sun Valley, but all of his biggest customers are Andy Jassy of AWS, Sam Altman, Satya Nadella, not just a customer, but obviously an investor and partner. And what they all have in common is that they've made continued commitments to not just big picture expand data center capacity, but NVIDIA has this commitment to bring out a new generation of GPU annually. And so you have two things happening: a broader expansion of capacity, where NVIDIA holds a monopoly, more than 70% of the market, but also a refresh, a technology cycle that's gone from being multi-year to annual, which is astonishing. And people rely on that technology as a bedrock of what's happening. On the Perplexity thing, it's not a deal that I've been hearing about here at Sun Valley, but it's been talked about for a little while. We had Perplexity's chief business officer on the show last week, I believe, and we asked him point blank, and he wouldn't comment, but said, you know, he wouldn't be doing his job if he wasn't talking to everyone. The ecosystem on the operating system side is really changing, but NVIDIA 4 trillion. Yeah, cool moment. It's weird not to be in the studio for it. But you guys did it. Congrats.
You're in front of a mountain, which is also pretty good. NVIDIA shares up about 2.5% right now, eclipsing $4 trillion. And we had Ed Ludlow right here with us. You can catch more of Bloomberg Tech co-host Ed Ludlow at 11 a.m. Wall Street time right here on Bloomberg TV. And we didn't even get to this meeting that could be happening between Sam Altman and Mark Zuckerberg. I know we talked a little bit about it, but not enough. We've been having so much fun with this story.
Yeah, I mean, it will be interesting, unlikely in front of cameras, right? So we're not going to see that meeting. No. And also, who knows if they're going to talk to each other in an amicable way?
That's
Are they
true.
going to be angry with each other?
Fisticuffs, perhaps?
I doubt that is going to happen.
I don't think so either. It would be nice if we could get an official readout like they were presidents of a country, but we'll continue to follow that story. And up next, we're going to talk about airplanes because Boeing hits an 18-month high for jet deliveries. More on Boeing shares and the other airlines, or rather the airlines in general, next. This is Open Interest.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Well, U.S. plane maker Boeing delivered 70 aircrafts in June, and that is the most in 18 months, thanks to renewed U.S. jet exports to China. For more analysis on Boeing and the overall airline sector ahead of earnings, we're joined by Savvy Sith. She is Managing Director for Airlines over at Raymond James. It's great to have you with us. Let's start with Boeing, because there's obviously a lot underway when it comes to Boeing and their turnaround efforts, but there's also an element of trade policy here, and it seems like for now, those winds are blowing in Boeing's favor.
Thanks for having me, Katie. You're exactly right. It's it's great to see Boeing kind of turning around things and really showing improvement here in 2025. There is a lot of kind of uncertainty around the tariffs, and where components are made. And hopefully we'll kind of stick to the policy that was there before, which is that kind of global aviation supply is kind of tariff-free. But from an airline perspective, what we've been hearing is kind of Boeing has been delivering on time relative to new schedules and sometimes even faster, which is encouraging after several years of delays and mishaps. So, overall, a good setup here.
If, the airlines that you cover, Savi, for example, Delta, which announces earnings tomorrow, they use Boeing. They're never going to switch over to Airbus, or have they been doing that?
Thanks. But yeah, if you look at Delta, they fly both operate both Boeing and Airbus aircraft. So the largest carriers, American, Delta, and United, they fly both types. Southwest is another big carrier in the U.S. They're solely Boeing. So it's in their interest to kind of see a successful Boeing, but also have a kind of a tariff-free environment overall.
And focusing more specifically, of course, on the airlines, we get Delta kicking us off tomorrow. It just feels like demand hasn't been there. It hasn't returned to really robust levels. Occasionally we get these bursts of optimism and you see shares pop, and then we go right back to this sort of sideways chop that we've had for the past couple of years. Are you expecting something different here, or maybe more of the same?
Right now, we're seeing just more of the same, unfortunately, Katie, because, if you look at, you're quite right. You're seeing some, green shoots that maybe we'll see demand at least progressing closer to where it was at the end of last year, early this year. But then some headlines will hit and you'll see a reversal again. What we'd be looking for, at least post-summer is there a change in corporate travel behavior? If we have more clarity around government spending, how stimulus is working, how tariffs end up, is there more comfort or certainty in for some of that corporate travel to come back? So that's what we'll be looking for. But right now, there's no change that we can discern.
All right, Savi, great having you on the program. Thanks for joining us. Savi Sit of Raymond James, talking to us about airlines after Boeing deliveries came out, and tomorrow we get earnings from Delta. Now, NVIDIA is really in our focus. It is the first ever $4 trillion company. You're here for an historic moment as the company crosses over that $4 trillion mark. It is, of course, the most valuable company in the entire world, and we're going to continue to focus on it. Coming up in the next hour, Goldman Sachs Chief U.S. Equity Strategist joins us, David Costin, as well as White House Council of Economic Advisors Chair Stephen Miron.